Değerli misafirlerimiz, programımıza kaldığımız yerden devam ediyoruz. Düşük büyüme ve düşük faiz ortamında finansal merkezler başlıklı oturumumuza başlayacağız şimdi. Bu oturumu MRL Corporation CEO'su ve Başkanı Sayın Cornelia Meyer modere edecek ve diğer konuşmacılarımızı da hemen sizlere tanıtalım. Casablanca Finance City Authority CEO'su Sayın Sait İbrahimi, Luxembourg for Finance CEO'su Sayın Nicholas Meckel, Borsaİstanbul Yönetim Kurulu üyesi Sayın Halil Tunalı ve Frankfurt Main Finance Genel Müdürü Sayın Hubert Watt sahnedeler ve sözü onlara bırakıyorum.
Thank you very much, and thank you for already introducing us all. That's very kind of you. A very warm welcome to this last session of the first day, session 7, financial centers in a low growth, low interest rate environment. My name is Cornelia Meyer, and I will be the moderator guiding you on the journey of this panel. But before we start in the panel, I feel it's very important we do one thing. We have heard this morning from Professor Murat Yülekbey, from their excellencies, the ministers, the big crisis we have with refugees and all the things happening in Turkey, also with Europe, with all these masses of people who have to flee their countries and come to better places. And I think we should applaud. Turkey has taken in 2 million people or more than that. We should applaud Germany because they've made the commitment of taking in this year 800,000 people, which is 1% of their population. So let us all give a big hand for Germany and Angela Merkel. So now we're going back to the business of finance. In the aftermath of the financial crisis, the global economy has been characterized by a low growth, low interest rate environment. Particularly, OECD economies had very anemic growth in interest rates, ranging between 0 and 1%. Things looked different in some emerging markets, particularly China was the driver of the global economic growth. Other emerging markets also created growth impetus. The end of the commodity supercycle, and especially the reorientation of the Chinese economy away from infrastructure spending towards domestic consumption, brought an end to emerging markets as the engines of global growth. In the aftermath, the recent RMB devaluation, various emerging market currencies followed suit. We saw a sharp decline in Chinese indices. Over the last month or so, $5 trillion were wiped off global stock markets. Over the last 12 months, the anticipation of a Fed base rate hike has also brought about capital outflows from emerging markets to the tune of $1 trillion. So we are, in this session, addressing those issues. The structure will be, I will ask our esteemed panelists questions, and they'll use less than a minute to answer them, because it's going to be, think of this as more than a ping pong match rather than a panel, so we're all sort of waking up again. And then we'll open it up to Q&A, and in the end I will give a short summation. And let me introduce quickly our panelists. Mr. Weth, Managing Director, Frankfurt Main Finance. He is an economist. He used to be the chief economist for Asia of Deutsche Bank. So he's an incredibly qualified interlocutor. Mr. Nicholas Meckel, CEO Luxembourg Finance, is a former senior diplomat with experience in China. Also, a lot of people here have experience in the Far East. And he is now the CEO of Luxembourg for Finance. Mr. Said Ibrahimi is the CEO of Casablanca Finance City Authority in Morocco. Distinguished career as a banker, first in Paris and then as a CEO of a bank in Morocco, and then as the treasurer of the country, appointed by His Majesty King Hassan. And he is now the head of, as I said, Casablanca Finance City. And Mr. Halil Tunali, who is a professor, an economist, incredibly knowledgeable, a professor of none the least of Istanbul University, and he's a board member of Borsaİstanbul. So I'm going to start with you, Hubertus. I've known Hubertus for a long time, so I call him Hubertus. Now, has the low growth, low interest rate environment affected investment flows into and out of Frankfurt, and how? 1 minute.
Yes, it has. Obviously, there is always, in times of crisis, there is a flight to quality. So Japan, the US, and Germany typically being the countries that are safe havens in times of crisis. So we've seen a massive inflow in terms of investment, which also led at the beginning of this year to negative interest rates in bonds of 10-year durations, almost 10 years duration. I think the limit was about 8 years. So that has changed, however, since. But at the end of the day, and that's what you asked me for, to give you in a nutshell, yes, we've seen massive inflows in the sense of flight to quality.
And just to follow up, what was the impact of the slowing growth and currency devaluation in China as well as other emerging markets in terms of the attractiveness? And you sort of answered that. Frankfurt, London, New York, Tokyo, Hong Kong.
Yes, these are the places to really benefit from those flows. However, I mean, and we have been talking recently about massive outflows of emerging markets, and you even mentioned that emerging markets story is at the end and they're no longer the engines of growth. I disagree with that. Obviously, for many, many reasons, they will continue to be the engines of the growth. However, what we see here is a change of guards. China will no longer play the central role, and with China, with its growth being very much driven by sucking in raw materials, all the raw material exporter have suffered. But this change of guards takes usually a little longer than as a smooth transaction in front of Her Majesty's castle. The change of guards goes very seamlessly. It doesn't happen in emerging markets that easily. So what you see here is that countries like India, that countries like Pakistan, Indonesia, Vietnam, which are supposed to be new growth engine, and I'm absolutely positive also about Turkey playing a key role here, they will have to take up that slack China left.
Yeah, and let's not forget our friends also on the African continent. Very wise words indeed. Monsieur Markel. Investors were tracing returns due to low interest rate environment. This led to a massive flow into equities, obviously, because that's the only thing, a dividend is the only thing where you get sort of maybe a 5–6% return. Do we have a bubble? Have the developments since the RMB devaluation marked the end of sort of that equities bull market?
That's 2 questions in 1 minute. Okay, good. So let me nevertheless start with something very important, which is to thank the organizers for inviting me to your very important forum. It's always great to be back in your magnificent city. Do we have a bubble? I think by all accounts, if you if you compare the evolution of macroeconomic situations with the evolution of stock indices, I think that by all accounts, we have some sort of a bubble, not only in China, but also in the Western world, at least in equities. And the real question is not whether we have a bubble. The real question is whether this bubble will blow up or not, will burst. And I think that question, to come to your second point, is probably not going to be answered by China, but is much more going to be answered by the Fed, what is going to happen either next week or later in the year. The Chinese devaluation is certainly a macroeconomically very important moment, but I think you would be utterly wrong in blaming it only on China's will to prop up its economy. Don't underestimate China's strategic goal of internationalizing its currency. And I think personally that that is the main motivation for China's devaluation of the renminbi. I mean, we can discuss China for the rest of the evening and even the whole night, and I'm very happy to do so if you wish.
Yeah, that is very right, because they also want to be assent to be part of the SDR, the special drawing rights, and in order to do that, they need to liberalize. They needed to do what they were doing, and transitions are always difficult. It may not be as quick as the changing of the guards, it's certainly less well organized than the changing of the guards.
And if I can add to that, I mean, we almost historically reacting to a 3.6% devaluation. We have seen a euro devaluation of 15% since the start of the year. We have seen a yen devaluation of 11%, and yet here 3.6% devaluation creates a hysterical reaction.
That is a very good point. That is a very good point. Then, Mr. Mackel, your second question is, what is the impact of the investment preference for equities on the Luxembourg Financial Center?
Well, Luxembourg's financial center, if you look at it, has specialized over the last couple of years in investment funds, and obviously they stood to gain very much so over the course of the last month and even years. We are now at 3,650 billion assets under management in the investment fund industry in Luxembourg, which is of course a direct consequence of the money flowing into equities. Why? Because people are looking for higher yields. I think we've spent the whole day discussing this. We also have another consequence directly linked to the previous point on China, which is that Luxembourg's role over the last 3-4 years as a renminbi hub in Europe has really solidified, playing on our traditional strength as an entry gate into the European Union for the Chinese banks, as an investment fund distribution center where investors from throughout the world use Luxembourg funds to invest into Chinese A shares. And then, of course, on the Luxembourg Stock Exchange, which is specialized in international bond listings, renminbi bonds are one of a success story where we play the leading role of stock exchanges outside Asia.
Hubertus, do you want to answer something to that? Because I know you feel very strongly about the importance of Frankfurt for the renminbi market.
Absolutely. Obviously, I only can congratulate Nicolas Mackel to the extreme success Luxembourg had as a financial center in terms of investment. Obviously, there is a race in Europe as far as it comes to renminbi trading. There is Paris, there is London, there is Luxembourg, and there is Frankfurt. By the way, it was the first renminbi hub in Europe. And the interesting thing there is, and a lot of people forget, and a lot of people are worried about what's happening with China, because Germany trades as much with China as UK, Italy, and France combined. That's very often forgotten, but yet it is only 6.2% of the overall trade of Germany. So even though it's very important, it's a small thing. But when it comes to renminbi, and you rightly pointed that out, we all believe, I think we are very much in the same camp here, that the yuan has a fabulous future, that it is not only vastly expanding in trade, it becomes increasingly an investment currency, which plays to your strengths. And we also see and very strongly advise the German exporters and importers with China to use the RMB, because they can so much better assure themselves against fluctuations of the currencies much better than any of their trading partners in China could.
It's called a natural hedge. And although it pains me to say this, being a UK national, if I look at the adding of the Italian, the British, and the French economy, you know, your economy is, pains me to say, you have the bigger economy. Very painful for a British to you know, we used to have an empire. Now I have to say they have a bigger economy. Sad.
I won't apologize for it.
Now we're going now to the emerging. We've talked about emerging markets, but we're now giving the voice to the emerging markets. Monsieur Saidi Brahimi, CEO of Casablanca Finance Authority Morocco. How has the low growth, low return environment impacted on Morocco's attractiveness to international capital flows?
Thank you, Cornelia. Still 1 minute?
Yes.
A lot of pressure. Yeah. Well, let me start by saying that we have noticed that the OECD countries have suffered from anemic growth. But there is a bright spot near the Eurozone, which is Africa. And Africa is hosting some of the most fastest growing countries in the world. Not only Nigeria, but you have 6 among 10 fastest growing countries in the world are in Africa. And Morocco is benefiting from this fact because of our positioning as a hub to Africa. We have this positioning thanks to our geographical position, but also thanks to our long-lasting political stability, our infrastructure, our strong regulation, and efficient banking and insurance sector, which is heavily investing in Africa. So we noticed that international investors are looking for high returns, and they are looking to Africa, and Morocco benefited from this interest. And that's why we have noticed that our FDI inflows rose by roughly 44% since the financial crisis. We are today the third largest recipient of FDIs in Africa. So
It's very good, and as I forgot to mention, you have the second largest financial center in Africa. And you also have, with your infrastructure, both physical and intellectual, you are geared to being the hub, not just for Africa to Europe, but also to the United States. And you have very strong links with the United States. So that's very true.
yes, if I may add something about Morocco, we have free trade agreements with the Eurozone, with the United States as well, with Turkey, and with several Arab countries. So from Morocco you can access roughly a market of more than 1 billion consumers, which is very important. And that's why our position as a hub to access Africa is really a good positioning, and people are feeling that is a way to access and tap the potential that African countries can offer.
And then the second question, you get a few more, the emerging markets people get a few more questions because we are in emerging markets. The second question is, how much has Morocco been impacted by the recent emerging market-induced turmoil? What was the effect of, what happened over the last month or so?
Well, I would say that when we talk about emerging markets-induced turmoil, we may think of two main things. One, the last year's collapse in commodities prices, which is very important, and that had already had a significant impact on some oil export countries. And the second point is obviously China's economic slowdown and currency devaluation, which is not really an issue. With 3.6% of devaluation is not a big challenge, but it has had a broader weakening of Asian and African currencies. So, back to your question, China represents today the single largest partner to Africa, and it's also a major investor in infrastructure projects. So when China's economy is slowing down, it may have impact on their investments in the continent. For Morocco especially, the impact was really limited because China direct investments in Morocco are quite low, and also because China is our 18th partner when it comes to Moroccan exports. So if there is a slowdown in their economy, there won't be any impact, strong impact on Morocco's economy. But talking about Africa, there is certainly a great impact in the countries that are which economies rely on natural resources, and in countries that are linked to Chinese investment for infrastructure.
Yeah, that's a very important point. That's really an important point to make that linkage. Now, the last question to you is: do you fear that a Fed rate hike, which it is probably not going to happen tomorrow, it's certainly going to happen over the next year or so. So it's not an if, it's a when. Will eventually lead to massive capital outflows from Morocco and other emerging markets. Are you worried for Morocco? Are you worried for other emerging markets?
Well, as you say, this won't happen in the next weeks or next month, I guess. We recently noticed that the IMF published a paper urging the Federal Reserve, to delay its rate rise, because the consequences that this may have on the global economic growth prospects. And the recent sharp decline of emerging market currencies is attributed to a large extent to the forthcoming potential for Fed rate hike instead of Chinese depreciation, of course. And this rate hike will lead to a renewed stress on emerging economies, and will affect their currencies, I guess. I would like to say that when it comes to Morocco, our external treasury debt is only 15% in US dollar. So rate hike will not hurt our economy. And if we talk about our stock exchange, we have 90% of foreign investments that are strategic holdings by institutional investors. The floating foreign investment is only 3% of market cap. So I would say that I'm not really worried for the Moroccan economy, but once again, the rate hike in the Fed by the Fed Reserve will definitely have an impact on several emerging markets.
So we're going from the Western Mediterranean over to the Eastern Mediterranean. And we are very privileged to have with us Mr. Halal Tunali. And my first question to you is, how have the low global growth and interest rates affected the attractiveness of Istanbul as a financial center?
Thank you. Istanbul's ranking in GFCI index increased 30 steps only in last 5 years. Why? Because Istanbul has some advantage among other finance centers. For example, Istanbul is, as you know, Istanbul is the bridge between Europe and Asia, covering over 60 countries, only in 4-hour flight zone. Connected to the leading global centers. Many international companies opened their official center in Istanbul. Compared to developing economies, Istanbul is the financial center of 18th biggest economy worldwide. So, because of these features, Istanbul hadn't affected negatively from the low global growth and interest rates. And also, I must mention that after the crisis of 2001, Turkey managed to recover its economy by initiating structural reform programs and committing to prudential, fiscal and monetary policies. Thanks to such initiatives, Turkish economy recorded an average growth rate of 4.7% between 2004 and 2014. Inflation and interest rates fell down to single-digit levels as unprecedented in Turkish economic history. As the end of 2014, Turkey's European Union defined government net debt stock to GDP ratio fell to 34%, and its budget deficit to GDP ratio is 1.9%, which both are significantly below the Maastricht criterion.
You certainly put a lot of European countries to shame with those numbers. I mean, especially sort of the budget to GDP ratio. My God, I mean that's quite a number. Now I come to the questions are getting harder as we go on. I apologize. The next one is, what is the impact of the recent emerging markets-induced market turmoil on Istanbul? The same as we asked. What happened in the Eastern Med, and like you're a bridge. How has it affected your bridge? Is the foundation still as strong?
Yeah, we try to transform Istanbul among top financial centers. In this regard, the enactment of new capital markets law in December 2012 has been a game changer for financial markets in Turkey. With the new law, Istanbul Stock Exchange merged with Istanbul Gold Exchange and Turkish Derivative Exchange to form Borsaİstanbul as a joint stock company. After the merger of separate exchange, Borsaİstanbul became a one-stop supermarket for all kinds of financial instruments, and investors have the opportunity to trade in a wide range of products. Also, Borsaİstanbul is at the heart of Istanbul International Finance Center project. Within this framework, to renew its technological infrastructure, Borsaİstanbul made an agreement with Nasdaq IMX. With this agreement, Borsaİstanbul will obtain state-of-the-art technology employed by the leading exchange of the world, and Borsaİstanbul will be able to accommodate 100,000 orders per second. And also will have the right to make change and improvements on this technology solution that will enable Borsaİstanbul to develop and maintain its technology in medium and long term. So when we consider all these things, emerging markets in this market turmoil did not affect negatively Istanbul and Borsaİstanbul.
Let's just hope that these 100,000 transactions are not meant for capital outflow, but for capital inflow in the majority. But that was just, I was trying to be funny. It clearly failed. The third question to you, which is a very quick answer, it isn't, and I'm sorry I have to ask it, but how has the attractiveness of Istanbul as a financial center been affected by the geopolitical developments over the last year? These are very, very difficult times, and you do live in a very, very difficult neighborhood.
Yes, it's true, but I must give some examples. For example, in May 29, 2015, was a milestone for Istanbul and Borsaİstanbul, because Borsaİstanbul signed a term sheet with EBRD, European Bank for Reconstruction and Development, paving the way for a pre-IPO investment by EBRD in Borsaİstanbul. With the agreement, EBRD will acquire 10% stake in Borsaİstanbul. Following the approval of Turkish Treasury and Capital Markets Board. This means that geopolitical developments over the last year did not affect negatively cash inflow or strategic partnership.
Okay, so you said there's no cash outflow.
cash outflow from Istanbul or Borsaİstanbul?
Not from Bursa, Istanbul as a financial center.
Istanbul Financial Center. Yes, there was some cash outflows, but this is normal because we have also some political problem.
Yeah, and you have a very difficult neighborhood, and if people invest, they want to invest in
Syria.
stability. If people invest, they want to invest in stability. And can I just quickly, I'm going to open to the floor in 1 minute. Both Mr. Fit and Mr. Mackel are getting 30 seconds to just sort of address the whole geopolitical environment issue from a financial sector, from their investor standpoint. You go first.
Okay, I'm taking the privilege. Thank you. 30 seconds, quite a challenge. Let me probably start to say to Mr. Ibrahimi and Mr. Tunali how important I feel that you succeed in building your financial centers in this part of the world successfully. Your shiny examples of what can be achieved and what has to be achieved to get stability and growth in this area. So I believe your role to be very, very important. Let me add secondly to that, despite Frankfurt being a safe haven and benefiting from flight to quality, this is not what we want. We need the emerging world to grow. That's where the future is, that's where the growth is. So it's so much better when a country like Germany having trade surpluses can export its capital in financial centers which can make use and in terms of prospering growth. So what we want is not flight to quality, what we want is good places to invest.
Yeah, Monsieur Mackel?
Thank you. Yes, I will just start by echoing what Hubertus said and add to that I think stability, whether it is economic stability or geopolitical stability, is really what the world needs in order to sustain growth. And we see it with China. As soon as there is a glitch, the knee-jerk reaction of investors is this is going to be a bursting bubble. In fact, it is a wake-up call, it is a reality check, but we see it in many areas, whether it is with the oil price, with the nuclear deal in Iran. We will see it, hopefully not, but we might see it with a crisis in Ukraine getting worse before it gets better. So geopolitics is something that you can never take out of economics.
Truer words have rarely been spoken. Now, on that, and I think most of us who've dealt with emerging markets we've been at the sharp end more than once of that truth. So I would like to open now for a maybe 10-minute Q&A, then I'll do a 2-minute summation, and then we'll be basically close to where we need to be time-wise. So who would like, do we have mics? Do we have microphones? Yeah, we have microphones, yeah. Brilliant. Okay, excellent. So who has a question? Furkan, can I give the first question to... Who has a question? Professor Dr. Murat Yülekbe.
Just to stimulate people. Now, if we separate the financial centers into two groups, one of them is, let's say, a country like Germany and city like Frankfurt, which has a big economy. So that means you could have a financial center in Frankfurt even without internationalization, let's say. Similar for Tokyo, in a way. Tokyo is not really an international financial center. It is mostly a local financial center, but a huge economy. So, you know, the other is, let's say, Luxembourg, which has a small economy itself, but it became, so without international, Luxembourg Financial Center could not survive, if I could say it that way. it's more or less like, let's say, Singapore airport versus, let's say, Atlanta.
Yeah.
You know.
Yeah.
Now, what would be the differential or different effects faced by these two, you know, let's say, polar types of financial centers in an environment which is like today, which is the world is slowing down, you know, even China is slowing down, etc. And then the returns are low, and a lot of people, like in Turkey or, you know, other parts of the world, are looking for financing, not only for the sake of it, but also for, let's say, infrastructure and growth and so on. Is there any differences in the challenges that you are facing, or is it the same type of challenge?
Do you want to start, and then we give it over to Hubertus?
Thank you. That's a very interesting question. Maybe I have to reach out back into history and 1957, when we created the European communities, we also created the single European market. This single European market is what actually is Luxembourg's domestic market. Legally speaking, it is not accurate to look only at the confines of the nation state of the Grand Duchy of Luxembourg to look for a domestic market for our financial industry. With free movement of goods, free movement of people, free movement of services, and free movement of capital, our domestic market is the European market. Just the same way as the domestic market of Frankfurt is not limited to the city of Frankfurt or the Land Hessen, but to the Federal Republic of Germany and beyond the European single market. Just the same way as the port of Hamburg doesn't serve the city of Hamburg only, but serves not only Germany, but far beyond. It's an entry gate into the European market. The same way for Luxembourg. Now to your question, of course, our investor base, Luxembourg is an international financial center, and we connect investors, whether they are from Europe or from further afield. Brazilians who want to invest in Chinese capital markets, they do that via Luxembourg, because that is an ecosystem where we have built up over 30 years now the competence to do that. American asset managers distribute investment funds throughout European markets and beyond through Luxembourg. So of course, all the shivers that will happen will reverberate through Luxembourg also. So we follow this very carefully, like everybody else. We are not immune because we are an international financial center, but I pass the floor to Hubertus, but I suppose that he will, for Germany, say just the same.
Yeah. Before we go to Hubertus, this is exactly what you are. This is exactly what you are to Africa. This is exactly, actually you're taking a leaf out of the hymn sheet of Luxembourg in Morocco.
Absolutely, Cornelia. The Moroccan economy is quite small economy, and it wouldn't support the emergence of an international financial center. So we have built our financial center gathering financial institutions, professional services related, and regional headquarters for multinationals, offering the access to the African market. And without the African markets, our financial center won't have existence, won't be successful as it is today.
Now, Hubertus, you are also a connector, but you also have a pretty big economy.
Well, thank you. I remember you'd like to tease us. So now let me just turn the table to Nicolas, like what we've did the other way around with Remedy. I can only echo what you said. And there is always, when you look at financial centers, you look at the way they compete with each other, and you forget how much they complete each other. Today's financial centers are very intertwined, and I believe the relationship between Luxembourg and Frankfurt being an exceptionally good one. On top of this, obviously, we have very good relationships with Paris and London. And I believe today's Frankfurt financial market would not function close as well as it does without those very close ties to Luxembourg, Paris, and London. Though there is also a sharing of work, a sharing of labor. And obviously, and in this respect, we envy our colleagues in Luxembourg. Being a smaller duchy, of course, you can move faster. And for our financial center, it's always good to say, look, Luxembourg is moving fast. We have to speed up. So competition is a good thing. It's a good thing to have. And anyway, by a more agile player, it is always good to learn a new trick.
Long live frenemies. You know, this wonderful thing of where you put friend and enemy together and becomes a frenemy. So long live frenemies. Do we have another question? Well, if we don't have another question, as it seems we do not have, I think in the interest of all of you long-suffering people, and we are standing between you and the real treat, the speech of Mr. Turhan. So in order to make sure that Mr. Turhan can speak very, very quickly and has more time, I will, if it's okay with the panelists, you would like to say something? Yeah. Absolutely, you should.
I think that Istanbul will continue to attract cash flows because of its economic capacity and dynamics. For example, Istanbul's economy is greater than 25 European countries.
Yeah.
And has a dynamic and young workforce with 28.9 median age. Also 2.6 million workforce live in Istanbul with 81% holding graduate degrees. 60,000 international trading companies are in Istanbul, and 200 billion foreign trade has a share of foreign trade in Istanbul, so its capacity is very big.
And I think you put your finger onto something here. I mean, the young economy. Our problem in Europe is we're all aging too fast. Our problem in Japan is we're aging too fast. And you know, China is the next fastest, biggest aging economy. So yes, you have a huge advantage with the young people, and you are actually able to do something with those youth. In many countries, the youth is just a youth bulge. You're actually positively employing them, which is just a wonderful thing to see. So I mean, thank you for that very important vote. So what we've seen today is the last turbulent years have brought us to a flight to quality that has obviously helped financial centers such as Frankfurt, Tokyo, US. China, whereas China is still a very important economy and is the second largest economy in the world, but some of the fast growth may shift to other places such as Africa. Do we have a bubble in the equities market? Yes. Is an end in sight? No. As long as we have such low interest rates, equities are the only alternative if you need to make a return, which most of us do need to make. Then we've seen also that you have companies like Luxembourg and Frankfurt. Everybody's vying to be this hub for the renminbi, which is absolutely, for the yuan, which is absolutely true because it's an important currency. And if and should they and when they get access to the special drawing rights, they will even be more important as a currency. Then we went to the two emerging market centers, and we've seen they both have one thing in common. They're both bridges. Morocco is the bridge of Africa to Europe and to the US. And Turkey is obviously the bridge of, is the bridge, Istanbul is the bridge between East and West. And has, as you so rightly said, so many countries within 1 hour of flight. When we look at Morocco, you have a free trade agreement with Europe, US, and the Arab world. I mean, most countries would envy you. You have the infrastructure. Yes, end of the commodity super cycle has certainly affected on Africa, because a lot of Africa is about commodities. It has affected on the Chinese investment, but not so much on Morocco, precisely because you are that link. The same for Istanbul. Istanbul is such a vital center and such a young economy that we can see a bright future for Istanbul as a financial center. And I would like to end with the wise words of both Monsieur Mackel and Fett, where said we need emerging markets. We should really look at emerging markets. We need them as engines of growth, as good trading partners. And good economies also mean that you have stability, political stability in countries. Then the wonderful thing is the can-do aptitude that we see in Istanbul. We've seen in Istanbul for a long time, that we also see in Morocco, or in Casablanca and Casa. And also the financial centers, they are completing each other rather than competing. Yes, they're competing, but they're completing and they can learn from each other. Frankfurt, which is big and a bit slower, can learn from the nimbleness of Luxembourg. And so with the words of long live frenemies, I will hand over to Mr. Turhan.
Konuşmacılarımıza teşekkür ediyoruz.